All right, today we're going to build an investor's toolkit. Look, have you ever felt like stock analysis is some kind of secret language that everyone else gets, but you're definitely not alone. But it doesn't have to be that complicated. We're going to build a simple but really powerful 5-step framework that'll help you analyze any company out there and do it with clarity and confidence. Let's dive in.
Does this look familiar? Yeah, a screen just packed with numbers and ratios and charts. It is so easy to get lost in all that data. It's total information overload. You just sit there thinking, where do I even begin to make sense of this?
Well, that is exactly why we're here. We're going to cut right through all that noise. We're going to build a structured process, a set of tools you can pull out every single time, so you can focus on what actually matters and start making smarter, more informed decisions.
So here's our game plan. We're going to move through 5 essential questions. First up, what is this company? Second, is it actually profitable? Third, is it growing? Fourth, is the stock a good deal right now? And finally, what does everyone else think? Simple, logical, and really, really effective.
Step 1 is all about getting our bearings. Before we even think about looking at a single financial ratio, we need to know who we're dealing with. What does this company actually do? Where does it fit in the grand scheme of things? And just how big is it?
So the first and most important way to measure size is market capitalization, or just market cap. It sounds fancy, but it's super simple. You just take the number of shares a company has, multiplied by the current stock price, and boom, that's the market's total valuation of the company. It's like its official price tag, and it's the quickest way to know if you're looking at a giant, a mid-sized player, or a small up-and-comer.
Next up, we need some context. Every company lives in a broad sector, like technology or healthcare, and then a more specific industry, like software or maybe medical devices. Knowing this is absolutely crucial because you should always be comparing apples to apples. I mean, you wouldn't compare a bank's financials to a car manufacturer's, right? It just wouldn't make any sense.
So with just a few little data points, we can build this simple company ID card for any stock. And just like that, we know Innovate Corp is a big $150 billion American tech company that makes software. See, this basic profile is the foundation for everything that comes next.
All right, now that we know what the company is, it's time to pop the hood and check the engine. We need to know, is this business actually making money? This next step is all about profitability.
This is really the fundamental question, isn't it? A company can have the most exciting products, sales can be going through the roof, but if it's consistently losing money after all the bills are paid, that's a huge red flag. We have to know if the core business model is healthy and sustainable.
To answer that, we're going to look at 2 key numbers. Gross margin tells you how profitable the company's products are all on their own, before you even think about stuff like marketing or office rent. But net margin? That's the real bottom line. It's the percentage of revenue that's left after every single expense has been paid. This shows you the company's true, final, take-home profit.
And you can really see the difference right here. A company might have a fantastic gross margin of 60%. Wow, that looks super profitable. But then, look what happens after you pay for R&D and marketing and salaries and taxes. That high number shrinks all the way down to a net margin of just 15%. Seeing this gap helps you understand how efficient the entire business really is.
Okay, so we've found a profitable engine. The next logical question is that engine getting stronger? Step 3 is all about growth. We want to know if the company is gaining momentum, if it's expanding its reach and becoming more powerful over time.
Now here's a really important distinction. There are 2 kinds of growth we need to watch. First is sales growth, sometimes called top-line growth. That just tells you, is the company selling more stuff? But then there's earnings per share, or EPS growth. That's the bottom-line growth, and that tells you if the company is actually becoming more profitable for its shareholders.
So for example, seeing a 15% increase in sales over the last year, that's a great sign. It shows that people really want what the company is selling and it's grabbing more market share. This is the fuel for the engine.
But look at this, the EPS grew by 25%. Now this is a powerful signal. When profit growth outpaces sales growth, it means the company is becoming more and more efficient. For every new dollar of sales it brings in, it's keeping more and more of it as pure profit. That is the hallmark of a really high-quality business.
So we found a profitable, growing company. It's really tempting to just stop right here and say, I'm in. But step 4 might be the most critical one of all. A great company is not always a great investment if you pay too much for it. This is where we have to talk about valuation, basically the stock's price tag.
The most famous valuation tool out there is the price-to-earnings, or PE ratio, and it just compares the company's stock price to its annual earnings per share. To put it simply, it tells you how many dollars you have to pay for every $1 of that company's profit. And generally, a high PE means investors are expecting big things, a lot of future growth.
But here's the catch. A PE ratio is totally meaningless without context. For example, a fast-growing tech company might have a PE of 50, and that could be a fantastic deal if its profits are about to explode. Meanwhile, a boring, steady utility company with a PE of 15 is probably just fairly valued for its slow, predictable business. And a struggling company with a PE of 8, well, it's cheap for a reason. It's risky. The PE always tells a story. You just have to understand the context.
But what if a company isn't even profitable yet? Well, then the PE ratio is completely useless. That's when we turn to another great tool, the price-to-sales, or PS ratio. This one compares the stock price to the company's revenue. It is a fantastic tool for looking at those young, fast-growing companies that are just reinvesting everything back into the business. We're at the final step. We've done all our own homework, and now it's time for one last check, kind of like getting a final report card from the experts. This step uses some really cool scores and professional opinions to either confirm what we found or maybe raise a red flag we might have missed. Here are two incredibly useful scores. The Prechoronsky F score is like a report card for financial strength. It grades a company from 0 to 9, and a high score is a fantastic sign. Then there's the Altman Z score, which is even more direct. It actually measures the probability of bankruptcy. A score above 3 is considered safe. These are just quick, powerful ways to check the company's financial health.
And finally, we can take a peek at what the Wall Street pros think. The analyst consensus rating just bundles up all the ratings from the folks who cover the stock for a living. Now, this isn't a reason to buy or sell all by itself, but it gives you a great snapshot of the current mood in the market surrounding the company.
So there you have it, your complete 5-step checklist. First, you identify the company. Second, you check the engine's profitability. Third, you measure its growth. Fourth, you figure out if the price is a good deal. And fifth, you read the final report card from the experts. This is your toolkit. You now have a repeatable, logical framework you can use to analyze any stock that catches your eye. You have the tools to cut through the noise and focus on what really matters. So the only question left is, what company will you investigate first?